Hi, my name's Paul Knott and I'm the author of Ouch. Well, I'm hoping it's the first book on money you would want to read rather than feel you ought to. So my thoughts are that a lot of people have a latent interest in money and finance, but the barriers to entry are too high. So people are either too fearful, bewildered by the complexity of it, or just find the subject just too dull and boring. And therefore the whole point with Ouch was to try and smash through those barriers and do that with humour, analogy, and make it generally a lot more entertaining. So what I say is it's quintessentially irreverent, but with a deadly serious message. So it's a bit like a good friend inviting you into a bar for a drink, and then you being gently coshed over the back of the head with an education before you've realised it. So the idea being it's meant to be a one-stop shop which shows you how the system really works and how you can protect yourself in a financial meltdown. Most people would be surprised if they actually knew how money is created. The banks are able to create money out of nothing and then charge you interest on it. So imagine you had a company where you were allowed to do that. It would be fantastic because there's almost unlimited upside. Now, in most companies, you would expect that you'd have at least some kind of downside, i.e. if you took too many risks, that you would then go bankrupt. But what we have at the moment with our current system is you've got the upside, but you've got no downside. So the general populace will step in when banks get it wrong. So, I mean, even an educationally subnormal hamster could run a business on that basis. Say you had a printing press in the backyard and you could create £5 notes, and you were really good at this so no one could tell the difference. Obviously this has a couple of consequences. One, it increases the money supply, so that tends to drive up prices because the purchasing power of each £5 note has decreased. But secondly, and more importantly, you get all the benefit. Because you've created something from nothing, you're able to swap that for tangible goods and assets. So the secret is that if you're first in the chain, you get the benefit. And the same applies to our banking system. Because they're creating the money first, they're getting most of the benefit. A lot of people think we have, capitalism is the problem. But we don't have capitalism at the moment. What we've got is some quasi-system. So call it cronyism, call it kleptocracies, call it nouveau communism, whatever you want. But what we've got is a hybrid system where you can benefit if you, on the profits, but there's no downside to that. And that isn't capitalism. Capitalism in its raw form is creative destruction. If you fail in a business, then it goes to the wall and something else grows up in its place. We don't have that with banking. It's claimed, well, it's got a special situation, therefore we can't. But it hasn't always been like that. There's been times in the past where banks have gone bust. And some would argue that why not do it again? Because at the moment, what's happening is the money's going out the back door instead of the front. Everyone's still funding these collapses, except they're not collapsing. The temptation is to try and find individuals and blame them, but there's a bigger problem there in that there's a systemic problem, and it's not just down to individuals involved. So, for example, expecting bankers not to be greedy is a bit like expecting politicians to tell the truth or teenagers not to be interested in sex. It's just a ridiculous standpoint to take. My view is that the current situation is very similar to what we had in the 1920s and 30s. If you strip everything away and look at what happened then, there was a massive increase in credit, and there was also huge financial mismanagement and fraud. So we had the Wall Street crash in '29, But what we also had was, for example, in the States, the Pecora Committee that investigated all this, and that then led to the Glass-Steagall Act of 1933. Now that remained in place for 75 years before it was repealed in 98. And then we basically went through the same process again, which was a massive expansion in credit, huge fraud. The only difference this time is that no one's really been punished for it. The big increase in property prices that we've seen over the last 15 years, of course, has been a huge boon to people who own multiple properties. No real benefit to if you just own one, and a general disaster if you don't own any, because they're now out of people's reach. But if we look at the components within that, we have, for example, location. So if you build a 10-bedroom house in downtown Detroit, it's not going to be worth very much. Whereas if you build it in Mayfair, it'll be worth considerably more. Why? Location, 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 as everyone's aware. But what does that mean in practice? Well, really, it's the land component of those property prices which has increased tremendously compared to the manufacturing and building prices. So the reason for that is because we've seen a huge expansion in the money supply and the availability of credit. So house prices tend to be based on the credit available and also the willingness of the individual to take on that credit. Now, when prices are booming, everyone feels quite confident and then wants to get into the market. But this is where the credit crunch came in. That moves in cycles as well. And as you get into the end of that process, that then reverses, and then suddenly the system starts unwinding. Of course, in London, we've got a particular situation in that prime London properties continue to rise, but that's mainly, I think, because there's been such an influx of foreigners who've come in worried about their money disappearing in their own countries, such as Greece and others. I think an important point, and I think you've made this in, via Positive Money, is that not only is there a problem with the creation of money, but there's also a problem with its allocation. So, for example, if you're a bank, you're much more likely to loan to someone who wants to buy a house than maybe who wants to open a business. Why? Because there's a tangible asset behind that purchase with a house, and they can reclaim that if you don't keep up with the payments. Whereas if you give to a business and it's a limited company, well, if it goes wrong, you may not get your money back. Now, the problem is that giving to housing is fine, but it's not a productive asset. Businesses are. And if you took this to an extreme, we'd all be living in houses, but there'd be no trade going on.